130 days. That is the number that should terrify every executive, every politician, and every investor who spent the last decade betting everything on the electric vehicle revolution. 130 days of supply. For context, a healthy car market moves vehicles in roughly 60 to 70 days. Gas-powered cars right now, about 74 days. Electric vehicles? A staggering 56 days longer. That gap doesn't sound like a speed bump. That sounds like a market that has quietly and brutally stalled. And yet, here is the maddening irony at the heart of this story. The industry knew this was coming. The automakers knew. The analysts knew. And they plowed forward anyway, spending $55 billion building a future that the market, at least right now, is flatly refusing to buy. This is not a story about whether electric vehicles are good or bad technology. This is a story about what happens when trillion-dollar ambition crashes into the cold, hard mathematics of consumer reality. About inventory that won't move, about resale values that have evaporated, about companies that are now hemorrhaging billions in write-downs, halting production lines, and quietly retreating from promises they made in boardrooms just 3 years ago. Buckle up. Because this is the full, unfiltered story of the EV crash, and it is far worse than most people realize. Let's start with the most fundamental question in any market. Is anyone actually buying what's being sold? According to Cox Automotive's EV Market Monitor, the gold standard for tracking vehicle inventory in the United States, new electric vehicle days of supply hit 149 days in November 2025. That represents a jaw-dropping 42% increase year over year. Let that sink in. In a single year, the pile of unsold EVs on American dealer lots grew by nearly half. By the time the new year rolled around, days of supply had settled at 130 days, still 73% higher than the same point a year earlier, and a full 56 days above the equivalent figure for gas vehicles. This is not a seasonal blip. This is a structural, systemic mismatch between what manufacturers are producing and what buyers are willing to take home. Now, zoom out globally. In Europe, the situation has taken on an almost surreal dimension. The ports of Antwerp and Zeebrugge, two of the continent's most vital automotive import hubs, are filled to absolute capacity with unsold Chinese-manufactured EVs. Automakers have been forced to lease emergency overflow storage at additional facilities because there is simply nowhere left to park these vehicles. This is not a logistical inconvenience. This is the physical manifestation of a market that bought the supply chain promise of the EV boom, built the factories, shipped the cars, and found buyers weren't there. There is a critical mechanical reason for why this inventory crisis is so damaging. Every car sitting on a lot for 130 days is depreciating in value, tying up dealer capital and signaling demand weakness to Wall Street. When institutional investors see this data, it triggers write-downs and strategic retreats. 130 days of supply is not a number, it is a verdict. But the inventory crisis is almost just a symptom. The disease is something far more financially brutal, and it affects you if you bought an EV in the last 3 years. Imagine you made a responsible, forward-thinking decision. You spent $48,000 on a brand new Tesla Model Y. You told yourself, this is the future. This is smart. Here is what the data says happened to that $48,000 investment. After 5 years, your Model Y is now worth approximately $24,998. You have lost $36,225. That is a 60.4% depreciation rate. That is not a typo. Over 60% of your car's value has ceased to exist. Compare that to a similarly priced internal combustion engine vehicle, which depreciates an average of 39 to 50% over 5 years. In dollar terms, that difference can represent up to $10,000 of additional wealth destruction simply for having chosen the plug-in option. The Model 3 tells the same story. From a $36,200 starting price, the 5-year resale value crashes to roughly $21,493, a loss representing a 55.9% depreciation rate. For a vehicle that was sold on the promise of efficiency and value, this is a stunning reversal. And then there is the segment that truly exposes the depth of this crisis, the premium and work vehicle market. The Ford F-150 Lightning and the Porsche Taycan are experiencing 60 to 75% value drops within just 3 to 5 years. The very truck that was supposed to convert blue-collar America to electric is now worth significantly less than the gas-powered version it was meant to replace. In the UK, data from CAP HPI revealed something startling. In a single month, January 2025, 3-year-old EVs lost 1.1% of their residual value, approximately £240, in 30 days. 1 month. That is the pace of erosion the used EV market is enduring. EV depreciation is not arbitrary. It is driven by technology anxiety. Buyers fear that the battery in a 3-year-old EV has already begun to degrade, typically losing 1 to 2% of maximum range capacity every year. A car that did 300 miles new now does 280, and next year it will do 271. Add to that the flood of new models making older EVs obsolete and the massive inventory glut we just discussed. Which brings us to the question of who exactly is doing all that dumping. To understand how profoundly wrong the EV bet has gone for the world's biggest automakers, you need to start with a single aggregate number: $50 to $55 billion. Written off, erased, charged against earnings. That's the collective toll of the EV industry's overestimation of demand. Let's start with Ford. In a move that stunned the industry, Ford Motor Company took a $19.5 billion charge against its EV assets. The company halted Lightning production entirely to prioritize gas-powered truck manufacturing. The Lightning had its own production line turned off. General Motors tells a remarkably similar story. The company delayed 2 Cadillac electric vehicle models and unceremoniously dropped its ambitious target of producing 1 million EVs in 2025. Total charges incurred by GM in 2025 relating to its EV pivot, over $7 billion. This was not a strategic adjustment, it was a strategic demolition. But the single largest implosion belongs to Stellantis, the vast automotive conglomerate that owns everything from Dodge and Ram to Jeep and Fiat. Stellantis took a write-down of $26 billion, which included $2.5 billion just on supply chain resets.
Volkswagen canceled or indefinitely delayed planned EV models. Nissan retreated from planned U.S. EV expansions. The industry-wide accounting of this retreat reaches $50 to $55 billion in total write-offs, a number so large it defies easy comprehension. As bad as this surrender looks in a boardroom, however, nothing exposed the fragility of the EV thesis more expensively than what happened at the world's largest car rental company. In late 2021, Hertz CEO Mark Fields announced that the company was ordering 100,000 Tesla Model 3s. The stock surged, the headlines celebrated. Then reality arrived, in the shape of a repair invoice. Hertz discovered that its EV fleet was generating repair costs approximately 4 times higher than equivalent gas-powered vehicles. Minor accidents that, on a gas car, might require a bumper replacement were, on a Tesla, triggering suspension system recalibrations and sensor array replacements that independent repair shops were not certified to perform. Wait times stretched from days to weeks. Simultaneously, depreciation was savaging the asset base. Hertz was watching its EV fleet lose up to 50% of its value within a single year of operation. The revenue those cars generated could not come close to covering the asset write-down. Across the Atlantic, the European rental giant Sixt was arriving at the same grim conclusion. Battery repair costs of €20,000 or more per incident were making the fleet economics non-viable. Both Hertz and Sixt cited a damning operational metric. Utilization rates for their EV fleets ran 20 to 30 percentage points below equivalent gas vehicle fleets. When a rental customer has a choice, they frequently choose the gas car because they know the gas station is everywhere. Hertz ultimately sold 20,000 EVs at heavy losses in 2024, executing a controlled retreat from an experiment that had become a financial emergency. The total impact on Hertz's balance sheet was catastrophic. But if the rental companies discovered these problems after spending billions, consider what the ordinary consumer faces. The narrative around electric vehicles has always been built on the showroom floor. Zero emissions, lower running costs. What the brochure rarely mentions is what costs you absorb after you drive off the lot. Let's start with insurance. In both the United States and the United Kingdom, insuring an electric vehicle costs 20 to 50% more annually than insuring a comparable gas-powered car. The average EV insurance premium runs over $2,500 per year versus approximately $1,800 for an ICE equivalent. Insurance premiums are set by actuarial data. The actual cost of repairing an EV after even a moderate accident is dramatically higher. Battery management systems, high-voltage wiring, and the complexity of integrated electric drivetrains can turn a fender bender into a $15,000 repair event. Insurers are not padding their profits, they are pricing real risk. Then there is the battery replacement question. An out-of-warranty battery pack replacement for a Tesla Model 3 or Model Y currently runs between $15,000 and $30,000. Compare that to the cost of replacing a gas engine, which runs between $5,000 and $10,000, and you begin to understand why so many prospective buyers are choosing to wait.
And underlying all of this is the fundamental infrastructure reality. The United States has approximately 170,000 public EV charging points. But the comparison to gas stations is misleading. A gas station with 8 pumps can refuel 8 cars simultaneously in 5 minutes each. A charging station with 4 ports can charge 4 cars over 30 to 60 minutes each, at best. The throughput is incomparable. 40% of consumers cite range anxiety and charging infrastructure gaps as their primary barriers to EV adoption, which is why, increasingly, the CEOs who built these cars are speaking out. There's a specific moment in every market cycle when the optimists stop projecting and the realists start confessing. In the EV market, that moment arrived loudly. Akio Toyoda, the chairman of Toyota, stated plainly that the notion that EVs will dominate the market is simply mistaken. Hybrids, in his view, represent the realistic path forward. Coming from the man who runs the world's largest automaker by volume, this is not the analysis of a pessimist. It is the analysis of someone who has been watching the data. Jim Farley, the CEO of Ford, provided one of the most direct acknowledgments of the crisis when the lightning production halt was announced. Weak EV demand had forced the company to cut production, take billions in charges, and refocus resources on what buyers were actually purchasing. Mary Barra at General Motors acknowledged that EV growth is coming in slower than expected, dropping their 1 million unit target into the recycling bin. The $50 billion in write-downs across the industry is not a collection of individual corporate errors. It is evidence of systematic, industry-wide overestimation of demand. An overestimation fueled by government incentives, favorable media coverage, and competitive pressure. Every CEO who delayed going electric feared being called a dinosaur. Now the ones who went fastest are taking the biggest write-downs. The tragedy here is not that electric vehicles are bad. The tragedy is that a technology with genuine long-term promise was rushed to market, oversupplied, underpriced on the used market, and deployed into an infrastructure ecosystem that was nowhere near ready to support it at scale. So where does this leave us? The data tells a story that is painful but clarifying. 130 days of EV supply, 60% average depreciation, $55 billion written off. The EV market is not dead. Global EV sales continue to grow year on year. The technology is real, but the furious, subsidized, politically driven pace at which the industry tried to force that transition has created a reckoning that is only now becoming fully visible. The automakers who survive this period will be those who found the genuine balance: electric where it works, hybrid where it bridges, gas where consumers still demand it. The companies that bet everything on a complete and immediate transition have paid for that bet with tens of billions of dollars and years of competitive damage. The market, brutal, unsentimental, and always correct in the long run, is doing exactly what markets do, sending a clear, expensive, undeniable signal. The signal says, "We were not ready." Thank you for watching this full breakdown of the global EV market crisis. Every single statistic and report mentioned in this video is linked down in the description below so you can verify every number yourself. If you have better sources, on-the-ground insights from your own neighborhood or industry, or if you completely disagree with my analysis, let me know in the comments. I read them all. Make sure to subscribe for more deep dives into the global economy and the industries being reshaped by forces most people don't see until it's too late. See you in the next one.